So far this semester, we've covered two main types of financial instruments: equity, so ownership interest in companies, and debt. Now we're going to cover very briefly a third type of financial instrument that's very important, and that's derivatives. And we're going to start derivatives with option contracts. And then we're going to talk about futures and forwards, which are very similar. All right, so let's start with options. Options give the buyer of the option the right, and that's very important, the right, but not the obligation to buy or sell an underlying asset. And this underlying asset can be pretty much anything. So something with a varying level or price for a certain price. So the transaction will happen at a fixed, previously determined contractual price, which we call the strike price, by a certain date, which is a sort of fixed date, and we call that expiration date. Okay? So this right but not the obligation. So this is a contract that gives the buyer the right but not the obligation. That's what gives the name to this type of derivative option. That's where the name comes from, right? The right but not the obligation. So the buyer, the owner of the option, has an option to exercise or not, depending on the circumstances. All right. So in terms of definitions, one thing you need to be really aware of is the two types of options: call options and put options. And call options give the buyer the right to buy the underlying asset at a fixed price, and the put options give the owner of the option, so the buyer of the option, the right to sell the underlying asset, whatever that asset might be, at a certain price by a certain date. And this right but not the obligation, a very important implication of that is when you own a contract, a piece of paper that gives you the right to do something, but you're not actually obliged to do it, that's a very valuable option. And as a result, these contracts will have a value, meaning that if you want to buy them, you're going to have to pay something to get into these contracts. So the buyer of these, whether call options or put options, this very valuable right will require a cost, and we call that the premium. The option premium. So there is a certain value attached to it. And then you can buy the option, and before exercise, before the expiration date comes, you can actually sell it. And it's the price, depending on what's happening in the meantime, can fluctuate. The price of the option, the value of the option can go up or it can go down. Okay, so that's what options are. Let's see an example right away. AAPL. So this is an option written on a stock, which is very common. It doesn't have to be. Options are written on many different things, as long as there's, again, a number that fluctuates, a level that fluctuates, and stock prices certainly satisfy that condition. You can write an option on that. So the stock options are very, very popular and common. So this is an option written on Apple stock. January 2023, that means that's the expiration date. And in monthly options, the convention is that the expiration date is the third Saturday of the month. It's not too important. You don't need to worry about that. But what this means is this option will expire by the third Saturday of January 2023. And that means the last day you can trade this, buy it or sell it, will be the Friday before, the day before that Saturday. So the third Friday of the month is the last day when you can trade these before you have to make a decision to whether exercise it or not exercise it. The next number, 120, is the strike price of the option. So that's the price at which you are agreeing to trade the Apple shares, each Apple share, on or before the maturity date. Okay, trade, but what type of trade? Buy or sell? That's determined by that call option. So this means you have the right, but not the obligation to buy a share of Apple at $120 per share. Okay, so that's that strike price is telling us that we are agreeing to buy this if we want to, if it's advantageous to us, and if not, we're not going to exercise. That's our option. Okay, so this is a call option. And next number we see is the premium. Again, it has a value, right? Right now, this option is trading at $21.70. So by paying $21.70, you can buy this option that gives you the right to buy Apple shares at $120 per share on or before the third Friday of January 2023. All right. So some additional important things here now about this option. So this is the call option, giving the holder the right to buy. So one thing that's important is each of these contracts will actually be written on 100 shares of the underlying stock. So these numbers that you see, 120 and the premium 2170, these are per share, but actually each contract is a bundle of 100 shares. So when you actually want to buy this, you have the right to buy 100 shares of Apple. If you buy one option contract, this is giving you the right to buy 100 shares of Apple, and you're going to pay 100 times 2170. So this whole contract will cost you 2,170. All right. So again, each contract is 400 shares. Must be exercised on or before. So the third Friday of that month is January 20, 2023. Okay. Now, when would you want to exercise this? So you have the right, but not the obligation to exercise. Well, when would you want to exercise it? When would it be advantageous? You're going to want to buy shares of Apple at 120 if and only if Apple is trading at a higher price at that time when you decide to exercise it, right? Otherwise, it's not advantageous for you to exercise it. You will not want to pay $120 for each share of Apple if it's trading at 110, right? Because if you want Apple shares, you can go buy them in the market for $110. But if Apple is trading at 130, 140, then yes, it would be a great deal to exercise this option and buy them at 120 per share, and then you can immediately turn around and sell it in the market for 130, 140, so whatever is trading at. So options, a call option specifically, will give you a positive payoff if the stock is worth more, the price is worth more than the strike price of the call option contract. So strike prices here is 120, so this option will give us a positive payoff if Apple is trading at a greater price than the strike price of the option. Okay, so this will give us a positive payoff, which is one we will want to exercise. Otherwise, we're not going to want to exercise it. And the option is worth $21.70 per underlying share. So because it's written on 100 shares of the underlying, if you want this call option contract, we would have to pay $2,170. All right. So now, let's talk about payoffs to options, starting with the call option. And this is very important because this is, again, what dictates whether you want to exercise it, whether you should exercise it or not exercise it. And there are two very important terms here that we're going to call the strike price of the option K. That's an important terminology, so you should know that capital K is the strike price on that contract that you are buying. And there can be different option contracts with the same underlying Apple, same maturity date, expiration date, January 2023, but different strike price. This one is for 120. There's another contract that's 110. There's another one that's for 130, and a list of different strike prices. This is the one with 120 is the one we are possibly considering buying, right? And again, payoff is and exercise decision is based on where the stock price, the underlying price is at that time compared to the strike price. Okay, and with the call option, if the underlying is worth more than the strike price, that's great. That's positive payoff. So we're going to call that the price of the underlying at that point in time. We're going to call that S, capital S. Okay, so S versus K is very, very important. So that's going to dictate. Now we're going to have a positive payoff from a call option, specifically call option, if the strike price is greater than, if the price of the underlying is greater than the strike price. Okay, so if Apple is trading at a higher price than the strike price on the contract, that's great for the call option, right? Because you're going to want to buy it at the strike price and you can turn around and selling. So you can buy it at K and turn around and selling at S. So that difference, S needs to be greater than K. If it's not, then we have zero payoff. So that's the beauty of options, right? It's asymmetric. The payoff is asymmetric. We have profit, so payoff, positive payoff, if the underlying is worth more than the strike price, but zero payoff, not negative, but zero payoff otherwise, okay? And so we can summarize this. The formula for the payoff on a call option is going to be this function that's a maximum of either 0 or s minus k. Okay, so it cannot be negative. That's the beauty of options, is there's no negative payoff, right? So if s minus k is positive, then you have positive payoff. If s minus k is negative, then you have 0 payoff. And the profit, so this is just payoff. When you exercise, what's going to happen, right? So that's the payoff. But there's a cost to options. So profit is the difference between the payoff and the premium you pay for the option. Okay. So hopefully the payoff is going to be large enough to cover the premium you paid for the option when you bought it. All right. So that will dictate our profit. So the payoff diagrams are very important in options. So you should know how to draw the payoff diagram to a call option and a put option. So here what we have again is the Apple January 2023 $120 call option. And the payoff is this asymmetric thing, right? Again, what we have on the x-axis, what we have is the price of the underlying. So the payoff is dependent on what's happening to the price of the underlying, say Apple share price. Strike price is fixed, right? And what we said is if the price of the underlying goes above the strike price, we have positive payoff. If the price of the underlying is less than the strike price, we have 0 payoff. So that's what the diagram is telling us, right? We have 0 payoff until the price of the underlying, say Apple, hits the strike price. The moment it hits and it goes above the strike price, we get this 1-to-1 payoff, positive payoff. The greater the price of Apple, the greater our payoff, right? If Apple is trading at 200 and we exercise it, we're going to have 200 minus 120, $80 of payoff, because we can buy it. The option gives us the right to buy it at 120 and turn it around and sell it for 200. Okay, and then we need to subtract the premium to get the profit. So this is what the profit looks like. Everything shifts downward. So previous one was the payoff diagram. This is the profit diagram, right? And the whole thing is just shifted downward by the premium of the option by $21.70. So if we let the option expire, because the Apple is not worth 120 or more, so we just don't exercise it, we still have to pay, or we paid initially $21.70 when we bought the contract. So our profit is negative. We are at a loss. But the moment if Apple is trading more than 120, more than the strike price, we start to get positive payoff. If it's trading for like 125, we're going to have positive payoff, but we will have paid a lot more when we bought the contract. So we're going to have positive payoff, but negative profit. We still exercise it because at least we can limit our losses. We can reduce our losses. But to have a positive profit, the difference between the underlying and the strike price will have to be greater than the premium we paid for it, right? So it would have to be, the stock price would have to be 120 plus 21.70, so 141.70 or more for us to see positive profit from this contract. All right, so that's the call option.